February 5th, 2026. Amazon drops its strongest earnings report in history. Record profits. Operating cash flow reaches $139.5 billion. The balance sheet is overflowing with cash. 24 hours later, $230 billion in market value evaporates. Profits rising, cash flooding in, yet valuation collapsing. These three things shouldn't happen simultaneously, but they did. And the trigger was a single number, $200 billion. That's Amazon's announced capital expenditure budget for 2026. Not a loss, just spending. Yet the market reacted like it saw a death sentence. Here's what most people miss. The market wasn't punishing Amazon for investing. It was punishing them for a specific type of decision, one that locks up cash and eliminates exit routes. In capital markets, this has a cold technical name, illiquidity discount. The money is still there, but the freedom is gone. Stock valuations aren't free-floating. They're driven by underlying mechanisms. And one of the most ruthless questions is this: can the company still pull its cash back and buy back its own stock? When it can, the share price has a safety net. But when that cash gets locked into illiquid assets and buyback capacity weakens, the company loses its ability to self-rescue during a downturn. The market automatically applies a discount, not because of the profits, because the escape route just got cut off. To be clear, the sell-off wasn't driven by one variable. Free cash flow compression, weaker near-term guidance, and an unexpected capex jump all mattered, but they all point to the same structural message. Amazon traded flexibility for capacity. And when uncertainty rises, the cost of lost flexibility compounds. $200 billion isn't traditional expansion. It is an extreme tilt toward heavy asset infrastructure. According to industry estimates, most of this capital is being poured into proprietary Trainium chip production and next-generation hyperscale data centers. These assets, once deployed, cannot be easily liquidated. Capital begins to freeze. And when that happens, investors automatically switch valuation models. Tech companies command premium valuations because markets are willing to pay for the future. They tolerate high spending, low profits, even negative cash flow, because they believe future scale will absorb today's losses. But when capital gets locked in heavy assets, the market stops dreaming about the future. It starts auditing the present. Every dollar invested, how much cash does it generate back? This is called ROIC logic, return on invested capital. It's the valuation model for industrial companies, not tech platforms. The dream ends. The accountants start talking. Consider the scale. $200 billion in a single year. No tech company in the past decade has frozen this much cash in one fiscal period. It's nearly 4 times Apple's total capex over the past 5 years. It approaches Meta's total over the past 10. That $200 billion figure could theoretically buy back nearly 10% of Amazon's outstanding shares. It could fund a massive cash dividend to all shareholders. Instead, it's being poured into highly specialized infrastructure. Infrastructure that can be sold, yes, but not at anything close to original cost. This is liquidity loss in action. On the surface, you see a stock price crash. What actually fractured was the optionality of cash. The outside world debates AI strategy. Capital markets are debating something else entirely. Exit capability. This isn't a growth problem. It's a retreat capacity problem. The price wasn't sold down, it was locked down. Next time you see a similar AI investment panic, ignore the narrative. Watch 3 signals. First, can cash still fund buybacks? If yes, the premium holds. If the buyback channel is severed, the discount begins. Second, can infrastructure assets be sold? If they can be liquidated, it's reversible investment. If they can't, it's locked capital. Third, is the market now auditing a tech company using industrial company standards? From projecting growth to calculating payback. From discussing the future to auditing the books. This means the market is reclassifying the company. The only countersignal, if a company can simultaneously maintain dividends and buybacks, it's not liquidity lockup. It's just volatility. The real danger isn't AI investment itself. The danger emerges when all the tech giants simultaneously lock up their cash. Buybacks vanish. Dividends contract. Capital stops flowing. This isn't a bubble. A bubble means prices are too high, but capital can still retreat. Now capital is locked. The system enters what can be described as a self-reinforcing illiquidity spiral. In this cycle, valuations lose their buffer layer. Any decline transmits faster. Any panic spreads more synchronously. The market starts to look structurally fragile. The next repricing won't be slower, it will be faster. But the fundamental rule never changes. The market is always pricing the same thing, the ability to retreat. Not profits, not growth. That's what separates durable companies from fragile ones. And that just got compromised by a $200 billion decision. When cash gets locked, equity reprices. The market is sending a signal. It's not about pessimism, it's about optionality. And optionality just became the most expensive asset Amazon surrendered. Thanks for watching. This is the Fiscal Ledger, decoding the systems we still live under. The modern world wasn't born in a moment. It was engineered over centuries by capital, law, and design. From medieval credit to modern markets, Europe and North America wrote the operating code of power, and we're still running on it.